This is TreppWire with a special podcast. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Lucius Clay, Director of Banking Solutions here at Trepp. And joining us today is Matt Osborne, aka Oz, Senior Commercial Banking Officer with Eastern Bank. Matthew, welcome. Matthew, Oz, welcome. And I think we'll flip back and forth between your aliases depending on how it's going. Tell us a little bit about your background.
Sure, thank you. So again, I'm Matthew Osborne, the Senior Commercial Banking Officer for Eastern Bank. We are a $24 billion bank based in Boston, Massachusetts. And my responsibilities at the bank include overseeing our commercial real estate division, which focuses on investment real estate lending, and also our community development lending division, which focuses on affordable housing, nonprofit, and the education sector. I've been with Eastern Bank for 24 years, always on the commercial lending side.
A lot of people may not be familiar with Eastern Bank. Give us a little bit of background about the bank, its business, and how it's known with the community.
Sure, thank you. Yeah, so Eastern Bank, we're a full service bank. We have a strong commercial and consumer platform. In addition, we have an insurance company, the second largest insurance company in Massachusetts, in fact. And we also have a wealth management division. Well, we really are a full service bank. An important part of who we are, though, is our commitment to supporting our communities. You know, our employees, they volunteer a lot of their time. And through our Eastern Bank Foundation, we were ranked by the Boston Business Journal as one of the top 10 most charitable companies in Massachusetts. It's something we're very proud of. We're a vocal supporter of important issues such as advancing equity and economic inclusion. And under the community development lending division, which I work with, we have a very focused effort on financing affordable housing and supporting nonprofits. Thanks for letting me share that. I'm really proud of what we do.
Matt, that was an impressive background that you gave us there. But truthfully, I think your most impressive award is probably the most frequent shoutouts on this podcast since we started it 2 years ago.
So when we got into the pandemic, I started searching on, podcasts just on the real estate sector, and I came across yours. And I think it was right around the time you guys started, and really enjoyed it. You guys do a great job. Frankly, I was surprised when I first emailed you and you guys emailed me back. I expected that, it would be something that would go into a black hole, but you guys have been great. So
the reason we asked you is you obviously asked us some pretty insightful questions as a listener. Obviously, you're in the CRE lending space. So I think a lot of the topics we're going to talk about today are particular to your experience with commercial lending, especially during the pandemic-induced recession and the follow-up to that. So one of the things we thought we'd start with was, if people hadn't guessed that you're from Boston yet, they will soon. And last week, in the last few podcasts, we've talked about Boston being a growth area, especially in the life sciences space. So I did want to start out with talking a little bit about what you're seeing on the ground there in the life sciences space.
I assume your reference to people being able to identify me from Boston has to do with my accent. Just a guess there. The life science asset class has been an area of growth over the past few years, and Boston is one of the epicenters for the life science expansion. And that's driving a lot of real estate demand in the Boston market. There's been a lot written about that subject lately. For those that are interested, I'd point them towards an industry outlook report prepared by JLL. I get a lot of good information there. They provide a very comprehensive overview of what's happening in the market. There's been a lot of growth there. I think a lot of the growth is driven by demographics. One thing that's resonated with me in the stuff that I've read is, that report from JLL talks about how there are thousands of known diseases, and yet there are only about 500 of those diseases have any type of FDA-approved treatment. The report goes on to talk about how people 55 and older account for about 29% of the U.S. population, and yet more than half of U.S. healthcare expenditures are from this group, which makes sense, obviously, right? People living longer, more healthcare is needed. You combine all of this, and the result is that there's an increasing level of demand for healthcare services, and that sector is strong, and growing.
I have a ton of questions, Oz, about the life science industry in Boston, and I'd love to get your thoughts. I probably have 3 or 4 questions on this. My first question is, as you noted, the development in the Boston area for health science has been extraordinary, especially in that Cambridge market. Would you say that most of the development that they're getting there, most of the new tenants are net new, or are they coming from other areas in the Boston MSA? Is this like net absorption of new employers in that region, or is this, something where you're kind of robbing Peter to pay Paul?
I think it's all of the above. Existing tenants are expanding, new tenants are coming into the market, and also there are new businesses being created and forming that are introducing new tenants into the market. I think Boston's one of the top life science markets in the country, right alongside the San Francisco Bay Area, and San Diego. And I think the reason that we're seeing new companies form coming into the market, new tenants coming in, and tenants expanding is because Boston is desirable for a number of reasons. To begin with, it already has a mature life science market. For decades, the city of Cambridge, which is right next to Boston, it's been the epicenter for lab space. Kendall Square, which is a section in Cambridge, I've seen it referred to in market reports as, quote, the most innovative square mile on the planet. On top of that, Boston has a very strong talent pool to draw upon. And it's also an area that is supported by a strong research and educational infrastructure. So you combine all of that, and it makes for a very attractive area, for companies to come into and expand and grow. And as a result, the demand for lab space is extremely strong. I mean, right now, vacancy rates, they're 0 to 3%. Rents are rising, and we're seeing a lot of new development projects underway.
That leads me to my next question, which is, as you and I had spoken about in preparation for this, and we talked about the fact that Boston and Cambridge are not very big, right? I think you said there's 7 square miles in all of Cambridge, and that has to take up Harvard and MIT among those 7 square miles. So not a lot of square footage there. Do you expect that, like in the Bay Area, that this ultimately expands to benefit other nearby cities, Hartford, Worcester, Providence, where maybe some of this talent base spills over into nearby cities and it's an opportunity for real estate developers going forward?
I think that there's still more growth to happen in the greater Boston market before it expands to other cities. That certainly could happen, but for the moment with Cambridge, Boston, the seaport, pretty filled up on lab space and not a lot of additional land to develop. As you say, you're right. It's only 7 square miles in Cambridge, for example. We've seen surrounding areas like Watertown, which is just outside of the city, that has captured a lot of the lab space. And actually, they're pretty full now. And now we're seeing space, moving beyond Watertown into the inner suburbs around Boston. And I think a lot of companies want to be near the Boston central core, given that it's very difficult to find space in that area. The next, natural move is to be just outside of that core, in areas that have, public transportation, commuter rail, trains, things like that to get into the city. So I think there's still a lot more growth to happen in the greater Boston area before it expands into other surrounding cities.
It's a funny thing, right? The whole life science thing seemed to start, or at least the pharma thing, in that Marlboro corridor about 15 years ago, and where everybody kind of set up shop. And I think they decided it wasn't close enough to the talent base, right? And then everybody started to flock from Marlboro down to that seaport area. It's been really quite something to watch as Boston has evolved over time.
That's right.
So Oz, this all sounds like good news and tailwinds for life sciences, but of course there must be some challenges. So as you see it, what are some of the challenges for life science in the Boston market?
There's a number of things to think about for all parties involved, whether they be the property owner, the tenant, the investors, the lenders. At the root of it is the supply-demand imbalance. Lots of demand, very little supply. In short, there's just not enough space. As we talked about, the central Boston core is very filled. It's now moving into the surrounding markets. The challenge right now is the time frame that these tenants need to find space. One important pickup I read from the JLL report, and I want to make sure I cite my source on this, is that venture capital is the leading indicator for the need to lease space. And obviously the need to lease space is what drives real estate demand. Whenever a company has a capital event, there's typically a lease transaction on average 6 to 9 months later. That makes perfect sense, right? A company has a capital raise, most likely to fund the next stage of a product. And so now that they have the money, they have to find space to do the work and bring that product to the next level. So if you are a real estate developer, the challenge is that the lead time for a life sciences tenant to secure space is very short. Generally speaking, a tenant commits to this space when they get funding. So once they get funding, they need to find space and they need to find it fast. If you're a developer and you say to a tenant, I have the perfect spot for you. Let me build you a building. The tenant's going to respond by saying they simply can't wait 18 or 24 months to get into that building. They need that space now. So who's going to get that tenant? It's going to be the landlord who has the space ready to go at that time. But as we said, there's not a lot of space available at any given time. So what's happening now is some developers are building on a speculative basis, or spec as we call it. They're building lab buildings without a tenant in hand. And they're doing it because they're anticipating that when the building is finished, there will be tenants in the market that are ready to lease the space. So far, those landlords have been right. The challenge on the investor and the lending side is that constructing a large building without a tenant in hand is by definition speculative. There's just simply a higher level of risk for a spec building as compared to one that's pre-leased.
So diving into the lending side a bit more and maybe focusing on that. So, understood around the real estate developer side of things, but from the lending perspective, what are some of the challenges and potential gotchas for a lender?
I'd say there are two high-level considerations that come to mind. The first is balancing the risk between spec development and pre-lease development, which are very different risk profiles from a lending standpoint. All market indicators right now show that demand is very strong. But lenders always have to consider what happens if market conditions change. One thing to remember for lenders, unlike the equity side of the equation, our return is capped at the interest rate on the loan. So we have to be very mindful of the type and the level of risk that we take on as a lender for any loan that matter, not just lab space. The second thing that kind of comes to mind is really the concept that some of these tenants in the market are backed by venture capital. They are in the early stages of their life cycle, and as such may not be profitable. So you might have a tenant that has a great product under development, lots of raised capital on its balance sheet, but it's not yet profitable and it's using its cash to fund itself. It's really hard to know at what point do these companies become profitable and they can sustain themselves under their own operations as opposed to needing to raise more capital. Companies that are profitable versus companies that rely on raised capital offer very different risk profiles that lenders need to evaluate. So as much as we underwrite our borrower and the real estate itself, we also have to analyze the tenant.
It seems like, Oz, that wouldn't be the easiest thing to do, right? A lot of these are private companies, not a lot of data behind them, not a lot of track record. How do you get your arms around some of this, maybe opaque data as you're trying to underwrite the tenant, as you just said?
Well, developers are pretty in tune with this. And if they are going to negotiate a 10 or 15 or 20-year lease for a very large space, could be an entire building, they require that the tenant, share their financials. Now, it may not be a publicly traded company, so it may not be financials that are available to everyone in the market, but the developer will certainly get them. And I'm sure they have to sign confidentiality agreements. And those financials are allowed to share with lending parties because lenders need to get a view of them. And that is the challenge, though, man, is because we are bankers, we're not scientists, and we analyze them. We rely on outside reports, and there are some industry views that we can get from experts on it. But ultimately, it's very hard to know when these companies are going to be profitable. And there's different stages of companies, right? So some companies are in their early stages and have no revenue. They're not profitable and have no revenue. There are other companies that have a product that they're actually out selling and they actually have revenue, but they're still in the early stages of maybe some additional R&D. So they might not be profitable, but they have a much clearer path to profitability because they already have a product that's been accepted in the market. And then of course, there are plenty of life science companies that are profitable and relatively easy to underwrite them versus some of those early stage companies. But it's a lot of time and discussion goes into that issue.
Now that I'm hearing this, I've decided that without asking Oz to give away any trade secrets, I think I will probably, the next time I have a flu-like symptom, I'm going to bounce my symptoms off him and find out where I should turn as opposed to going to the walk-in clinic.
Perfect.
Well, we talked about life sciences and especially how it's been a boon in the office space. Let's pivot to another property type and one that turned out to be a sleeper during the pandemic and one that we probably would not have predicted going in, and that's self-storage.
Yeah, that's quite a pivot, Martha, because life sciences gets all the headlines, and self-storage always seems to be a little under the radar screen. It's a lower profile asset class, but one that has been a steady performing asset class for decades. It performed very well through the pandemic, better than steady, in fact. It was a high performer during that time. Self-storage today, it's certainly much less of a niche asset class than it once was. I still think of it as a specialty. It's almost like running a small business in a way, with real estate at its core. The first self-storage facility that we were involved in financing was in the late 1990s. At that time, it was a real specialized asset class. There were much less investors and fewer financing options back then than there are today.
As a lender, what makes this property type worth a look?
Well, self-storage has a lot of characteristics that make it attractive. Kind of similar to multifamily, self-storage has a highly diversified income stream. So if you lose a tenant here or there, there's really not that much impact on the overall performance. Self-storage typically has lower CapEx needs and offers, pretty stable year-over-year cash flows. So it's attractive in the sense that from an underwriting standpoint, you can look at the net cash flow from the property and underwrite it with a level of confidence. Over the past several years, self-storage has become more mainstream. It's attracting more investors and developers. But like any real estate property, you still need to know your local market. You need to have the right location and visibility. You need to know who your competitors are. And you need to have the right operator who uses technology to really market the business. That's been a big change over the last 20 years about how technology is used to market these properties. If I can give a shout out, there is a self-storage legend out there in the business. It's a gentleman named David Levenfeld and his company Storage Pros. He helped educate me years ago about the business, which really helped contribute to Eastern getting more involved in that space. So David, if you're listening, thank you.
So let's roll the clock a bit about to 2020, height of the pandemic. Like other CRE lenders, you were on the front lines when we had really an unprecedented amount of government support. How did that impact your playbook?
Yeah, that was a really unique time, probably an understatement right there. And I couldn't be more proud of how Eastern Bank assisted its customers during that pandemic. All of our employees just did such a great job. I think it'll actually prove to be one of the more defining experiences of anyone that went through it as a banker. And I know you've talked about it a bit on some previous podcasts, so I won't rehash it for all your listeners, but there's some observations that come to mind that I can share, like how that period, compared to previous experiences. In the early 1990s recession, that was a pretty severe real estate recession back then. And from an investment CRE perspective, there was very limited direct government intervention. Certainly not anywhere near the levels we saw in the past two recessions, or 2020. Back then the government had their hands full with waves of bank failures, and the real estate market was kind of in a tailspin with tightening liquidity, falling values, and foreclosure activity. And unlike the fast rebound that we saw after 2020, it took years for the 1990s market to recover. In fact, for any listeners out there that went through that period, they might remember that slogan that we had back in 1991 and 1992. It was "Survive till 95." But since then, we've seen increasing levels of government support with each subsequent recession. The 2001 recession, it was relatively light in terms of its impact on CRE, but government support did come in terms of interest rate cuts. In 2008, obviously, there was lots of government support that came in with the federal rescue plan. And then we get to 2020, and we saw a big step up with PPP loans, stimulus checks, extended unemployment support, and the like. I'll tell you, the support that we got in 2020, the importance of which I don't think can be overstated, was the lender's ability to give modifications on loans under the CARES Act, really allowing for payment modifications on loans, without necessarily having to put reserves on those loans like we may have had to do so in the past. That was a very powerful tool that really helped give breathing room, to all parties involved. What's really interesting for me personally is that most of the people that I worked with that went through that difficult time in the early 1990s, and mind you, I was literally just out of high school when this happened. They're now retired or about to retire. So here I am with memories of that time, and still a decent runway ahead of me in my working career. And when I talk to younger folks about it, I think sometimes they have a hard time understanding how challenging or extended a downturn could be. One interesting comparison between the early 90s and 2020, in the early 1990s, all CRE property types were affected. In 2020, certainly some were affected, but we actually had a few property types that did very well. And I know you guys have talked about this a lot on some previous podcasts. I mean, we've had some that have flourished. I mean, multifamily has flourished since this happened. Industrial has flourished. And self-storage, look at the numbers, it's performed very well. I think the takeaway from this is we often draw from our past experiences to try to predict how things are going to play out. But the circumstances change so much that it's just hard to predict things. I mean, if your next question, Lucius, is going to be, well, when's the next recession coming, and tell me what's going to happen, I'll tell you, time will tell.
No, I know better than to ask that question. I used to get it all the time selling risk models. People asking, tell me when the next Lehman's going to happen. I'm like, oh, okay. If I could tell you that, I wouldn't be peddling credit risk models here. So
I hear that.
So as we talked about past crises, and you combine that with a really extraordinary performance by certain property types over the last couple of years, we're now in a situation where, really remarkably low cap rates for multifamily, for self-storage, for industrial, probably for life science, although I don't know that market nearly as well as others. Do you think that the recent uptick in interest rates takes away some of this froth, or would you even call it froth? Like, to me, it seems a little bit overheated, or maybe you disagree.
This kind of gets back into the comment I made a moment ago about how we use past experiences to try to think about how things will happen going forward. Why it's such a hard question to answer, the one you just asked, is that one thing that's changed a lot is that I've never seen the level of equity chasing deals like it is today. And in past cycles, leverage is a lot higher. I think the underwriting discipline that the industry has is very good these days. And the equity has stepped up and said, okay, we won't lend, banks won't lend at 80% like they did, maybe in times past. We're willing to put in additional equity so that banks can lend at a level that they feel comfortable with. And all banks will, underwrite loans with cash flow sensitivity analysis and such. I think that people are willing to accept lower returns to own hard assets that offer stable returns and recurring cash flow. And does the increasing interest rates impact that? Of course it does. It has to, right? It's just logical that it will impact it. But if there is no other replacement place to put it, I do think that demand will remain strong. And I think the increase of interest rates will not have a direct linear impact on an increase in cap rates.
It's a really interesting point that you just made about discipline, because I happen to agree with you quite strongly that the discipline over the last, 5-6 years has been really, really amazing. And what really blows me away is all it takes is one guy to break discipline, right? If one guy breaks discipline and starts making 85 LTV loans, the rest of the market has to follow. Otherwise, you lose market share. And I think collectively, the industry has not seen that yet, where you have quote unquote cowboy come in and change the dynamic dramatically. And I think that goes a long way towards the reason why we may not have froth at this point, and why the next problem, the next crisis may not look anything like the last one. I agree with you completely.
Yeah, I think there's a possibility that the market has actually evolved a little bit too, in that sense, because the CLO market, I think, has picked up that demand out there for higher leverage loans. I mean, those higher leverage loans used to, one way or the other, find their way onto the balance sheet of banks or CMBS or life companies. And maybe there was a bucket that a lender had for those higher leverage loans. Maybe they charged higher pricing, et cetera. But those aren't going, from what I can tell anyway, those are not going to banks or life companies or CMBS anymore. It's gone to the CLO market that, from what I can tell, seems to be going in with their eyes open on the type of leverage they're taking on. I mean, they're raising money for this distinct purpose and getting paid for it. Debt funds have also picked up some of that slack as well. And those things, debt funds and CLO lenders, they didn't, correct me if I'm wrong, they didn't exist 20 years ago, right? They may not have even existed 10 years ago, the CLO market anyway. So I think that's been an important evolution. And probably there is a bit of opaqueness around it though, because we don't have visibility into what those lenders are doing, like we may have if larger banks are lending like that, or CMBS lenders are lending like that, where their information is more readily available. So that, as that continues to evolve, that'll be an interesting part of the market to watch.
You mentioned CRE CLOs. You mentioned debt funds getting in on the space and taking some of the riskier stuff up. That just means there's more and more competition among banks, insurance companies, et cetera, for the higher quality assets. Can you talk a little bit about the competitive landscape when trying to win a deal as a banker?
Yeah, you hit the nail on the head. I will say one thing. Your comment about how debt funds and CLOs are taking higher leverage loans. Like, I would suggest that the banks aren't competing for those, though. We don't really want to be in that space. We don't need to be in that space. But there is heightened level of competition for, stronger loans, particularly around the asset classes that we mentioned a moment ago. Every lender I know is interested in multifamily. Every lender I know is interested in industrial. Those are by far the two top asset classes. Retail is an interesting one. Retail, I think lenders are more selective, but for grocery anchored or credit tenant lease, that market is just as strong. It's very competitive to find those because you want to check the boxes on the right borrower, the right relationship, the right property, the right leverage level. When you have all of those governors, it serves to be a very competitive market.
So with that said, if there is a property type that you're intrigued by right now, what would that be?
It's a good question. One property type I'm kind of intrigued by, and from what I understand has done very well over the last 18 months, is single family rentals. And the reason I'm kind of intrigued about it is because we don't really have a lot of that. We don't have any of it from what I can think of in the Boston area. And what I'm referring to is, I understand that there are in other parts of the country, there are single family communities being built, almost like subdivisions that could have 50, 100, 150 homes in them. But instead of selling these houses to homeowners, they're being rented to homeowners. And I believe, you guys know better than I believe CMBS is actually starting to finance this stuff as well. Maybe they've been doing it for a while now. And the reason I'm interested in it is, one, we don't have it around here, so it's kind of a new thing for me to think about. But as I think about this model, I think about how do you underwrite the expenses on that long term? Anyone that owns a house knows that owning a house and operating a house is expensive, and it tends to get more expensive as it ages in terms of repairs and maintenance. Now, obviously, that logic applies to every real estate class, right? As a property ages, it becomes more expensive to operate. But when I think about like a 100-unit apartment building, that building likely has limited landscaping, limited common area. It has one roof, and it just has windows around the exterior. Now go to a 100-unit, subdivision where everyone's renting the houses, and you've got 100 roofs, you've got all those HVAC systems, you've got all these roadways you have to landscape and manicure, and a pretty high standard of maintenance, I would think. All leading to my question of like, how are these operating expenses being underwritten for the long term? I mean, a brand new built community is going to have a lower level of expenses because it's brand new. But as windows and gutters and roofs and HVAC start to get on in years, are they underwriting those expenses and that CapEx that's going to be needed down the road? That's actually one of the biggest misses I see in a lot of underwriting of every asset class is the CapEx. Is what the CapEx is going to be down the road, and are people planning appropriately for that? This asset class in particular jumps out at me because of all those elements I just talked about.
It's a great question, and it's something that we should probably bring on an expert to talk about. The asset class has found its way into securitization in a sizable way. We do see, throwing out a rough number here, but I'm going to say a half a dozen deals come out like this per year or so. I don't know enough about them. We do have modelers inside of Trepp that model these and model assumptions and so forth, and they probably know it as well as anybody. But you bring up great questions, and I think they're all of a piece that I think, just like you said before, it's hard to know what the next crisis will be and where it will come from and what it will look like and what inflation will do and so forth. We're in unprecedented times in terms of, will government intervention continue at the level it's been? How fast will the Fed move? What will inflation look like in a year? They're all just such unknowns. And I'll add to that unknown that, this week in Barron's, they talked about home prices being so extraordinarily high. In Boston, in fact, they had one of the places that they mentioned, I think it takes 7 times annual take-home income to buy a house right now in that market, which is up about 18% over 2 years. And Boston was kind of in the middle of other cities like New York and and San Francisco and other places where the cost of living is expensive. But this will have unintended consequences on all parts of the market, on multifamily, on demographics, on new development, and so forth. And to your point, I'm kind of giving a long-winded non-question here, but it really is hard to know where this ends. And I think we'll look back in 10 years and say, wow, how did we not know that this was going to benefit this property type, but not this property type?
Yeah, absolutely. One of the things you mentioned, about inflation is where we spend a lot of our time right now, and this kind of ties into valuations and housing prices and property values, is we're spending a lot of time analyzing the construction budgets of our development deals. And, I think we all know that there's a lot of pressure on construction costs these days. It's hard to find the GCs with the time. It's hard to find the subs. It's hard to find the materials. And sometimes when you think you find the materials, they don't show up or they get delayed. All of which adds to ultimately the development cost of a project. And there's a school of thought that the value of stabilized properties is, there's going to be upward pressure on those values simply because the replacement costs of trying to build now, add on top of that, the time and the effort to get there, is that it's almost easier to pay a lower cap rate for a stabilized property than go into the ground and try to build one, not exactly knowing what the market might look at like 18 months from now when you're done.
That's just a great observation. And I think it does help explain why these cap rates are extraordinarily low right now on the multifamily side. I think you throw into that also, I think that same article said we're kind of 2 million single family homes undersupplied. And you throw that in combination with the fact that it's so hard to build new product on time and under budget right now, it's probably a meaningful tailwind to existing inventory.
Which offers a pretty compelling exit strategy for the single family rental asset class that we talked about a moment ago. That's what actually intrigues me about that asset class, is that it has multiple exit strategies, right? You could sell it individually, you could sell it in its entirety, you could break it up and sell it to individual homeowners. There's all kinds of things you can do with it. And I'm sure that's an attractive aspect to anyone that might be looking at it.
Oz, as you know, we give shout outs on the pod each week to our engaged listeners like yourself previously. So who at Eastern Bank or in the world that works with Eastern would you give a shout out to?
Well, thank you for this. My first shout out is really to all of Eastern Bank's employees and the Eastern Bank Foundation and its efforts around advocacy. Our employees volunteer a lot of their time helping communities, and I'm very proud of that. As part of these efforts, Eastern Bank is focused on supporting gateway cities in markets like Lowell, Lawrence, and Brockton. I'm personally involved with the leadership in the city of Brockton, which is a gateway city just south of Boston. It's a great city with train access to Boston, relatively affordable housing options, and it's a community that has a lot to offer. So I certainly want to give out a shout out not only to that city, but also to Mayor Sullivan. He's not only a great mayor doing great things for the city, he's also a fellow graduate of Boston College, which is my alma mater. Along those lines, Eastern Bank is heavily involved in financing the development of affordable housing throughout all our markets. That's an important part of our business that we are very passionate about. And I say this from the heart. This type of housing truly does make the world a better place for the people that live in these properties. And man, it's back to the comment you mentioned a moment ago. 7 times someone's income to buy a property, I think you said. Affordable housing is such a critical part of what we need to do in this country. It improves the quality of the life of the people that live in these houses. So my next shout out goes to a person named Pam Feingold, she built this business for us at Eastern Bank from the ground up over the past 25 years. It's probably longer than 25 years, but she wouldn't mind me saying that. She just started when she was very young. But she runs our community development lending group, leading the charge on making the world a better place. Just a wonderful person. She's a legend in the Boston affordable housing market. A few additional shout outs to some people at the bank, people I work closely with, Nick M., Steve W., Mike M., Sean B., and John P. These are folks I work with closely. I'm sure they're listening, hoping I say something foolish that they can use against me. Special shout out to Stephanie P. and Olivia G. I don't think I could get through the workday without them. Thank you. And of course, a shout out to my very tolerant wife, Kim.
It's a good list. And before we close, I would be remiss if I did not comment on the fact that you have an interesting hobby talent. And I'm not going to say much more than that because I think you might want to share with everybody what that is.
Well, thank you for bringing that up. Yes, my passion is playing guitar, and I play in some bands. I'm actually playing in 2 bands at the moment. One band is called Side Hustle, and we play, radio-friendly songs. And then I have another band I play with my family, my sister on vocals, my brother on bass, and my friend Nick Z on drums. That's called Time of Legends, and that's where we play some hard rock in the vein of Led Zeppelin and ZZ Top, Aerosmith, and the like. That really gets my blood pumping. I actually have a guitar right here, and I'm going to play a rock and roll lick right now. There you go.
Excellent.
I have a gift for you guys.
You have a gift for us?
I have a gift. And so I actually had a friend of mine transcribe your introductory music into tablature, which I will email you. And if you like, you can post on your Twitter feed. You can challenge some of your listeners to maybe record the intro with using different instruments and different versions of it. Maybe people get a kick out of it.
That is cool. Manis, I know you love middle school band concerts. It's one of the things you've talked about before. Maybe we can get like a middle school band to play the intro someday.
I want to hear it in the French horn segment. That's what I want to, maybe we'll make that our lead in for several months. But then if we get like maybe an oboe version, really kind of mix it up over time.
And for anyone that's interested, that lead in music is in the key of A and in the pentatonic scale.
We love to give shout outs that, to Matthew's point, help the community. I love what Eastern Bank is doing with affordable housing. And I love that Matt gave shout outs to those people that are really doing the heavy lifting on the ground in the areas around Boston. I think that's wonderful work. Let me throw one back at Matthew, and let me remind people that, supporting your local musicians means also showing up at the bar, spending money on drinks, eating food, and helping local restaurateurs that have been really heavily hit these last 2 years. So make it a hat trick. Enjoy some live music, spend some money at the bar, tip your waitresses and waiters generously, and help these restaurants get back on the feet. And then it's win, win, win. Great stuff, Matthew.
Hear, hear.
With that, we'll close this special podcast. Thanks to our guest, Matthew Osborne from Eastern Bank. Thanks to our producer, Haley Keene. Join us later this week as we look at what's happened during the week and how it may be impacting you. If you have a question or a music cut or a music quiz question, send all of those to podcast@trepp.com. And check us out on trepp.com for more info. Subscribe to the podcast with your favorite provider. Thank you for listening and stay well. All right.